Do you ever feel overwhelmed by the idea of investing? Maybe you've heard terms like stocks, dividends, or mutual funds thrown around, but it all feels like a foreign language. Don't worry, you're not alone. Investing might seem complicated, but it's one of the most powerful tools for building long-term wealth. The good news: you don't need a finance degree or a huge pile of cash to get started. In today's video, we're breaking down the basics of investing in a simple step-by-step guide. Stay until the end because we'll share the most crucial tip for growing your investments over time, a tip that could completely change your financial future. Let's dive in. Tip 10. Understand why investing matters. Before jumping into the world of investments, it's important to understand why investing is so essential. Simply put, investing allows your money to work for you. Unlike saving, where your money sits idle in a bank account earning minimal interest, investing gives your money the potential to grow exponentially over time. This happens through the magic of compound interest, where you earn interest not just on your initial investment, but also on the interest it generates. For example, if you invest $1,000 and earn a 7% annual return, your money doubles in about 10 years. Leave it invested for 20 years and it grows to nearly $4,000. Over 30 years, almost $8,000. Investing helps you beat inflation, which erodes the purchasing power of your money over time. It's the key to achieving big financial goals like buying a home, funding your children's education, or retiring comfortably. By understanding its importance, you'll see investing not as a gamble, but as a smart way to secure your future. Tip 9. Set clear financial goals. Every successful investment journey starts with a clear destination. Ask yourself, why am I investing? Your goals will guide your decisions and shape your investment strategy. For instance, are you saving for a short-term goal like buying a car or a long-term goal like retirement? Short-term goals might require safer, more liquid investments, while long-term goals allow you to take on more risk for potentially higher returns. Define your financial goals with specifics. Instead of saying, I want to save for retirement, set a goal like, I want to have $1 million by age 65 to fund my retirement lifestyle. Knowing the amount and time frame gives you a clear target to work toward. Break your goals into milestones and revisit them regularly. As your life changes, your goals might shift and your investment strategy should adapt accordingly. Tip 8. Start early even if it's small. One of the biggest myths about investing is that you need a lot of money to get started. The truth? Starting early even with small amounts can make a huge difference over time. This is thanks to the power of compounding. The earlier you start, the more time your money has to grow. Imagine two investors. Asterisk investor A starts investing $100 per month at age 25. Asterisk investor B waits until age 35 to start but invests $200 per month. By age 65, investor A ends up with more money despite contributing less overall. That's the power of time in the market. If you're on a tight budget, look for platforms that allow fractional investing where you can invest small amounts in big companies. The important thing is to build a habit of investing regularly. It's consistency, not the initial amount, that matters most. Tip 7. Learn about different investment options. The world of investing offers a variety of options, each with its own risks and rewards. To make informed decisions, it's crucial to understand the basics of these investment vehicles. There are several popular options to consider when it comes to investing, each with its own features, benefits, and risks. Stocks are one of the most common choices. When you buy a stock, you're essentially buying a small share of ownership in a company. Stocks have the potential for high growth, but they also come with a higher level of risk since their value can fluctuate significantly. Bonds, on the other hand, are a safer investment. When you purchase a bond, you're essentially lending money to a company or government in exchange for regular interest payments. While bonds typically offer lower returns compared to stocks, they provide more stability, making them a good choice for conservative investors. For those looking for a diversified approach, mutual funds can be an excellent option. These funds pool money from multiple investors to buy a mix of stocks, bonds, or other securities. Similarly, exchange-traded funds, ETFs, offer diversification but are traded on stock exchanges like individual stocks, often at a lower cost than mutual funds. Real estate is another popular investment choice where you can buy property to earn rental income or benefit from long-term value appreciation. It's a tangible asset that many find appealing, though it requires significant upfront capital and ongoing management. Finally, there's cryptocurrency, which has gained a lot of attention in recent years. Digital currencies like Bitcoin and Ethereum can be highly profitable, but they are also extremely volatile and speculative, making them a risky option for beginners. By understanding these different investment options, you can choose the ones that best align with your financial goals and risk tolerance. Research these options and consider your risk tolerance, goals, and timeline before deciding where to invest. A diversified portfolio often provides the best balance of risk and return. Tip 6. Understand risk and reward. Every investment comes with some level of risk, and understanding this is crucial for making smart decisions. Generally, the higher the potential return, the greater the risk. For example, stocks have historically provided higher returns than bonds, but they also experience more significant ups and downs. If you're close to a financial goal or have a low tolerance for risk, safer investments like bonds or cash equivalents might be better suited for you. Ask yourself, how much risk am I comfortable taking? Your risk tolerance depends on factors like your financial situation, investment goals, and personality. While some people can handle market swings without breaking a sweat, others might lose sleep over a 5% drop in their portfolio. Tip 5. Use dollar cost averaging. Timing the market trying to buy at the lowest point and sell at the highest is nearly impossible, even for professionals. Instead of stressing about market fluctuations, consider using dollar cost averaging, DCA. With DCA, you invest a fixed amount of money at regular intervals, regardless of market conditions. For example, you might invest $200 on the first of every month. This strategy allows you to buy more shares when prices are low and fewer when prices are high, ultimately lowering your average cost per share. Tip 4. Keep your emotions in check. Investing is as much about mindset as it is about strategy. Markets go up and down, and it's easy to let emotions like fear or greed drive your decisions. When the market drops, your instinct might be to sell to cut your losses. But historically, markets recover over time, and selling during a downturn locks in your losses. On the flip side, chasing hot investments out of FOMO, fear of missing out, can lead to costly mistakes. Stick to your long-term plan and avoid reacting to short-term market noise. Remember, investing is a marathon, not a sprint. Stay focused on your goals and don't let emotions derail your progress. Tip 3. Keep costs low. Investment fees might seem small, but they can significantly impact your long-term returns. For example, a 1% annual fee on a $100,000 portfolio can cost you tens of thousands of dollars over 30 years. Look for low-cost investment options like index funds or ETFs, which typically have lower expense ratios than actively managed funds. Be mindful of transaction fees, account maintenance fees, and advisory fees, and compare costs across platforms before choosing one. By minimizing fees, you keep more of your money working for you, a simple yet powerful way to boost your wealth over time. Tip 2. Regularly rebalance your portfolio. Over time, your portfolio's balance may shift as certain investments perform better or worse than others. For example, if stocks in your portfolio grow significantly, they might make up a larger portion of your investments than you initially planned, increasing your risk exposure. Rebalancing involves adjusting your portfolio to restore your original asset allocation. This ensures you're not taking on more risk than you're comfortable with. Most investors rebalance once or twice a year, but the right frequency depends on your specific strategy. Tip 1. Stay educated and patient. The most crucial investing advice: keep studying and being patient. Markets are volatile but have traditionally risen. Reading books, viewing videos like this, and following credible financial news sources keeps you informed. Education helps you make confident, educated judgments. Patience matters too. Investing builds wealth over time. Follow your plan, be disciplined, and let time work. While investing may seem daunting, anyone can do it with the appropriate strategy. You may use investing to ensure your financial future by learning the principles, creating goals, and keeping disciplined. Which tip resonated with you the most? Are you ready to start your investing journey? Share your thoughts in the comments. I'd love to hear your plans and answer your questions. Don't forget to like, subscribe, and hit the notification bell for more videos that help you take control of your financial destiny. Thanks for watching, and I'll see you in the next video.